Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. So today I'm joined with Kristen Ragusin. How you doing today, Kristen?
Oh, nice to be here with you. I'm doing great, thanks.
Great. Well, glad to have you. It's interested. We had an interesting conversation prior to the show, and I'm excited to that the listeners will get to listen to Kristen as well. Kristen, tell us a little bit about your background.
Well, I started at five, really. I was always interested in money and I had to earn my allowance, which was $1 a week, explaining to my dad how the markets worked. So it should have been no surprise that after I graduated college, I started at Merrill Lynch and I was there for 28 years managing money, building a practice. And for the last 3 years, I've been at Raymond James doing pretty much the same thing. And I've also become a money reformer in my spare time, which led to this revelation about how we can easily change the money system and create freedom and prosperity.
Nice. So what kind of took you down that path? Like why does money need to be reformed?
Yeah, I think 2008 was a watershed moment year for me. I was doing a master's degree. I had been out of the office for a couple weeks. And when I got back, I saw some really secure AAA rated short-term papers starting to drop in price, and interest rates weren't moving. There was no reason for it. When I called the desk in New York, they told me not to worry about it, that everything was AAA and it was just a liquidity problem. And at that point, I thought, what point does a liquidity problem become a credit problem? And I started to say the cracks, for 2008. And they told me I was being negative, dramatic, so on. I got lucky enough where I got the client base out of the markets prior to 2008. And still, when I saw it happen, it was so horrifying. Guys that had been working there for 40 years, losing everything. And I thought, I'm missing something. I'm missing something in my worldview. And all the promises, even that, they weren't consistently upheld. And this led me down the bunny trail to find out I actually had no idea how money was really created, what it really was, and how it entered society. And that started this whole next journey. And there's some exciting things we could do to change the world pretty easily.
Nice. So, I mean, this is kind of brings it's kind of coincidental timing because right around 2008 is when Bitcoin was created. So, tell me your thoughts on cryptocurrency, blockchain. Like, what are your thoughts there?
Yeah, sure. I just want to make sure that nothing that I'm saying is construed as financial advice because I'm definitely not, encouraging anyone to make any decisions. But cryptocurrency, the idea of peer-to-peer money that's legitimate is so profound. It is the backstory of all human history. Even I would say the past 5,000, 6,000 years, people being able to create the money supply versus a centralized force creating the money supply has been the battle of the history of humanity. So, as important as the internet was and how it's changed the world, and I remember back in the late 90s when they were saying, oh no, it'll go away. No one will invest online. This will never be a thing. Blockchain is this important, and in fact, it may change our world more. So I would say there's a huge difference between Bitcoin and cryptocurrency, much like the difference was between Amazon and pets.com. So Bitcoin has tremendous amount of legitimacy as a new commodity, a new asset class, and certainly it's the only scarce commodity that exists on the planet.
Well, how can you say it's the only scarce commodity? I mean, there's plenty of scarce commodities.
I don't think so.
What about uranium, gold, silver, diamonds? Well, I guess no longer diamonds. They can make diamonds.
They
But
can't make. Yeah, no, I think there's plenty of gold. It's just that it's too expensive to mine, right? There's temporary scarcity that flows, and certainly there will be points in time that I would definitely agree with you and say, wow, this commodity is legitimately scarce at the time. But Bitcoin will be forever limited. So there will only be 21 million Bitcoin. And even though they can be divided into many different little pieces, which are called Satoshis, by the time we get to the complete mining or the complete distribution, there should never be another Bitcoin beyond 21 million.
well, technically, there could be if everyone agrees, right? I mean, if everyone agrees or enough people, the majority, right? You could have that.
True. That's true. Yeah. I think it would probably never happen, but that's absolutely true. If it did happen, like Bitcoin would lose its legitimacy. The whole ethos of what's behind it, the community. I mean, and also people say, what backs Bitcoin, this and this and that. There's a tremendous ethos and a tremendous commitment from that whole community, and they would lose everything if the quantity went beyond 21 million.
So let me ask you this. I mean, right now there's over, I believe, over 10,000 different coins out there. So, and they're all, I mean, many of them are very different. So, why is Bitcoin better than the rest, or is it even?
Yeah. I would say it's significantly different, and it's completely by its construction. It's in its own class, and most of the coins don't have limited quantity. And many of them even, sort of from the era again when the internet boom started, and this was really 2000. Before the 2001 really would have been the big bust of the dot-com era. And a lot of money was thrown at anything that was internet based. And this probably was going on in the cryptocurrency space 2016, 2017, where investors, private equity, you name it, they just needed to fit this cryptocurrency spot in their repertoire. And they were throwing money at anybody with like a 10-page white paper. And most of them had absolutely no money mechanics, no utility behind it. So what my bet is that Bitcoin absolutely will survive and thrive. It will probably be more of a store of value or replace gold. And maybe a handful of the other coins will still have some market dominance and show some legitimacy and importance.
Yeah, it's interesting. I mean, they finally approved Bitcoin as an ETF a few weeks ago, which was I don't know if it was a surprise to anybody or if it was a surprise because they'd pushed back so many times until the court finally just said, "Nah, sorry, you can't do that." It's all been very comical, but what stops another one like Ethereum from doing the same, or Solana, or any of these others? Like, why Bitcoin? Why not any of these others, do you think?
Yeah, I do. I think we'll see. I think we'll see Ethereum also. So I think either will come. That probably will take a little bit longer, and it still will have a different tone to it, just because again, Ether's basically unlimited, right? It's used as the basis. It has, in my opinion, at this point, legitimacy also, because it's used in many projects that have valid utilitarian uses. But and I think we're sort of at this beginning of the slow burn, where the Bitcoin ETFs, there's a number of things that have to happen. There's a lot of miseducation. People don't understand why Bitcoin is different than cryptocurrencies. Why is it, what legitimacy would it have like gold? Why could it even be better than gold? And as this starts to percolate in the mindset, and I think we're going to get a big ad campaign from the 11 or different investment houses or companies that put out the ETF, from BlackRock to Wisdom Tree and so on. It'll get more interest into the public. I think there'll be an about face of people saying, gosh, is there a difference between this and then an FTX? And then there'll be greater education of the financial advisor, broker, RIA population. There's probably more competency in the RIA population, meaning sort of small boutique investment companies that help clients. I think they're always sort of a little bit more on the cutting edge than your traditional big brokerages and wirehouses. And so as this education happens more and more for the financial advisors, we're going to see probably a greater allocation happening. That would be my guess. But still, firms themselves have to do due diligence when they offer these ETFs on their platforms. They're sort of having not a recommendation, but there's a sense of condoning it on a level. So they may have to put in restrictions for advisors and say, it only can be 3% of someone's portfolio, it only could be 5% of someone's portfolio, or the client themselves has to have a certain amount of liquid net worth. All of that is yet to be determined, and it'll be interesting how that begins to evolve.
Well, a few firms have even already banned it from use on their platforms. Like Vanguard doesn't allow it. I can't remember if Morgan or Merrill also banned it from their advisors, but I'm not surprised. I mean, those firms, the big wirehouses, also banned inverse ETFs and leverage ETFs a while back, which I thought is kind of interesting. They're protecting people from themselves. Probably they're protecting themselves from other people is probably more likely. But what do you think's going to come of that? Because when you start to have a few firms that say we're not going to allow it, um, all it takes is enough firms to do that, and then it's not really a thing. So, what are your thoughts there?
I think that could change on a dime. So that has a lot of validity. I think that's important. Vanguard is surprising. Merrill is not surprising. I think Merrill, to me, to some degree, there's nothing wrong with that because there is still a lack of education in the traditional finance camp. And often these camps have sort of seen each other as enemies. Traditional finance have kind of been wishing that cryptocurrencies would fade away and go away. And the crypto space or a lot of the digital asset space has been wishing that traditional finance would go away. And yet there actually is a Venn diagram that would lift up and make our financial systems and markets so much more secure, so much more transparent, and would provide a lot more real investment opportunity for people just by the financial innovations. So I think Vanguard, it probably, I mean, I'm guessing, but my personal opinion would be it's somewhat political. I don't think it would really help the government all of a sudden if Bitcoin went to 100,000 or went to 200,000, because that becomes a significant challenge to the dollar in a year where they're trying to lower interest rates when we still have questionable inflation, or we have the BRICS coming. We have sort of, lots of different types of challenges to dollar dominance. And at the same point in time, I think your bigger wirehouses that are absolutely driven by client demand, market demand, the more that clients clamor and want these ETFs, and the ETFs start to show that they have opportunity for reward, they'll turn and they'll allow them. But I think that they, again, may put some parameters around how that's done.
So, I know a lot's happened in the last few weeks, and just kind of watching each of the ETFs, and there's a big spread of expense ratios for each one, which to me is surprising. I mean, Grayscale is the closed-end fund, and they converted, and I would have thought they would have converted at a expense ratio a little bit closer to others, but it's a huge spread. But for what is 11 different ETFs that are public right now, like how should investors be looking at them? Is it just expense ratio, or is there more to it that they should be considering?
I mean, again, I really just I can't give out financial advice, but expense ratios are important for every investor to be looking at, because it has an impact over time. And it depends. Grayscale already has that brand name, so I think they chose not to lower their expenses, kind of counting on their client relationships and their sort of preeminence and dominance in the space. You have other issuers coming out and proving that they actually own the Bitcoin, that you're not buying something that they don't really have any supply backing up those ETFs. I think that would be interesting. The difference is also with Fidelity or custodied at Fidelity. The vast majority of them, you're custody at Coinbase. I think it was all but two of them are custodied at Coinbase. And so there are a lot of nuances in there. And again, this is sort of a brand new space where people are, just coming into this, and this could be extremely volatile. So, huge swings could come. And then, of course, I think certainly as people begin to pile in, this is just, we're still in the gambling phase, to say the least. Although it's very important in terms of the change of money, and even the concept of what self-custody is, and do we really have ownership of our money as it is?
Yeah, so let's pivot for a minute into money, because we talked a little bit about the show. when you're looking at banks, I think most people don't understand the nature of money, how it's created, and the changes that have happened in the last, I don't know, is it 16 years? So tell us a bit about, money and kind of the changes that have happened in the last decade or so that have really changed the financial system the way that it used to be, even.
Yeah, for sure. It's what I find so interesting is money is probably the most powerful, the most impactful force in our society, right? It impacts everything, even from all of our relationships, from the most mundane to the most intimate, and it impacts public policy, everything. Yet we have a relatively unconscious relationship with the unit of money or the dollar itself. We focus more on how are we going to make it, how are we going to spend it, and then how are we going to invest it. And yet money controls us more than anything. And it in fact was the founding source of the Revolutionary War. So we're sort of taught in school that the Revolutionary War was fought over religious freedom, but it really wasn't. It was over monetary freedom. And so when we have this unconscious relationship of what the heck is the dollar made out of? How does it come into existence? Where our lives are easily controlled by powers outside of us. So it's changed 8 times in the history of the United States. And today we're really on full, what I would call finance capitalism, even though we're moving into surveillance capitalism. And so industrial capitalism of the 50s has really gone. Investment capitalism is questionable as to whether or not it really occurs. And so what all of that mumbo jumbo means is that banks basically create 97% of our money supply. It's really not the Federal Reserve. And they create the money on the spot when a borrower signs a promissory note to take out a loan. So there's no fractional reserve lending anymore. There's 100% of the money comes into existence when a loan is taken out. And so it's just created through dollar book entry. If somebody borrows 100,000, it's $100,000 as an asset to the person created on one side of the column. And then it's a minus 100, which is that loan, the asset to the bank or the liability to the person. So every single dollar we see or every single dollar in our accounts is a consumer loan that belongs to someone else. And the big kicker for this is that when that debt is repaid, obviously the debt is wiped out, but so are the dollars. The dollars are deleted, the dollars are destroyed. So every time debt is repaid in our society, we have less money. If the federal government were to pay off our massive debt, we would have a depression of inconceivable measure because all of that money would disappear. And so as soon as debt is repaid off as a collective, the collective is worse off and we need more and more debt to be taken out. So it sounds like an impossible situation because personally, we also have to pay off our debt. And money was never created this way in the past. And I really believe it is why we are destroying the middle classes, we're destroying the working classes, and we're destroying the basis of investment and capitalism. And our founding fathers and the founders of this country knew this, and they began to issue money properly. But the British didn't like it.
So let me ask you this. I mean, you made a great point that, banks create 97% of the money supply. But as banks have not been lending since pretty much 2009, they stopped lending for a bunch of different reasons. But the Federal Reserve is still printing money. I say that in air quotes because everyone says they're printing money. So how does that work if money is still being created and banks aren't really lending? And they'll tell me, they're like, yeah, we're just not lending anymore. So how does that work?
that's exactly where booms and busts come from. So booms and busts come from private debt exceeding the ability to pay the monthly payments. So because we've really gone to this rentier economy. Certainly when I was growing up, You wanted to own something. You wanted to own a house. You wanted to own your car. You wanted to own your phone. And we've moved into this whole idea that we should rent everything, whether we're paying it on a monthly payment, whether kids are becoming indentured servants by paying back their college forever. There's some Social Security recipients getting their Social Security docked for college debt, even though we've seen some of that obviously wiped out, which is not the remedy per se, but just to really sort of drive this point home, because it's a shift in consciousness. And so it is just like the game of musical chairs. We have to borrow money faster than it's being repaid. And when it hits a critical mass where new money is not being created by the banking system, it absolutely triggers the 2008. It is what created 2008. It's not even that the banks really lent to borrowers who could not repay. I mean, obviously that was part of it, but the reason why they were lending to people in a really unethical and really, just wrong way was because they had to quickly go down and get more and more and more debt created as fast as possible. So this is often where wars come from, or you could look at the funding of Ukraine or all of these different kinds of things, not a political point, but this expansion of the debt because humans cannot run on that hamster wheel fast enough to create debt. This is why you get decades of endless wars from various kinds of enemies, because they need to keep that war machine going to create more debt. Um, and this is truly why housing has gone up extremely. In the 70s, you could have one salary in a family, and a home was 3 times, 5 times salary, where today a home big enough to raise a family can be 10 times, 12, 15 times salary. And this is because our money supply is being created out of debt, consumer debt.
So, this, so where does this all go? I mean, because I've seen the trends and they don't look good. And um, so where does this all end? Like what cause, or if it does end, where does it all change? Because at some point things have to, debts have to be repaid. At some point the numbers stop working, at least to the trends they're at now. So like, what does that look like, or at least some scenarios as to what that could look like?
Yeah, this is where you get sort of the illegitimacy and the legitimacy of the Fed. So, where everybody says, "Oh, the Fed is the problem. The Fed has created this." It's really it's this bigger picture that our money supply is being created out of consumer debt. If the money supply was being created out of productive debt, meaning funding innovation, funding small businesses, which to your comment, where if banks are not lending, they have been still lending on mortgages. They may now be stopping that. But this boom in housing that we've continued to see and college debt. So if banks were to shift, first of all, if we were to have lots of small banks, if we were to have lots of community banks and regional banks who could be those traditional banks of 1934, sort of the It's a Wonderful Life movie, we would fundamentally change society right away, because those banks would be good citizens for the community, and they would be funding small businesses, which have really been the bulk of the employers, and it's the real economy. Because you need legitimate credit to be flowing into enterprise in order for to make the money viable. So the money supply itself should always equal how productive the people are, and it should fluctuate. So if the people are more productive, there should be more money in circulation. If the people are less productive, there should be less money in circulation. But we just have this sort of fake consumer debt money that puts us on the hamster wheel constantly, with the pressure to consume, take out debt, repay, consume, take out debt, repay, until it busts. And this is where booms and busts come from. The Federal Reserve can often act as other actors, whether it's through JP Morgan, whether it's through creating money to buy stocks to prop up the market. Years ago, I think Russia had decided they were no longer going to buy treasuries. And I can't remember if this was in 2010 or 2012, somewhere in this range. And suddenly, a little boutique firm showed up in Belgium and started buying massive amounts of treasuries. And it stuck out because it was greater than the GDP of Belgium. And sure enough, it was JP Morgan really acting as the Fed to buy up those treasuries to keep the price nice and tight to replace what was no longer being purchased by Russia. China owns very little of our debt. They really, we always are told that China, we owe all this debt to China. It's really not true. You can see the actual numbers at treasury.gov of who owns the United States debt. And it really is the United States people. It's pension funds. So we could actually get out of this situation softly if we chose to do that. But I think this is the primary reason why I wrote this book, is because this understanding of what money is has been taken out of the textbooks, and we needed to learn it in the first grade. So when we start to come back to the understanding that money is meant to be issued to represent production, and there's a whole way out of this. So many different things could happen. The money system itself could just sort of collapse, and the powers that be could choose not to rescue the dollar. In my opinion, that would be being done on purpose, maybe to bring out a new central bank digital currency, as creating the chaos and coming in with a solution. The other things could happen where we could come to the understanding that the national debt is really our own money, and we could very slowly create the money and pay that off in tandem with how inflation inflation was being created by that. And then I think really what we are going to see are alternative currencies coming in, that will be really new corporate money that will come. And I think we're going to start to see Amazon and Apple and all these different big companies, instead of just issuing stocks and bonds, I think it's possible that they are really going to start issuing their own script in the next X number of years.
That's interesting. Yeah, the CBDCs to me is a interesting um, offshoot of what's probably going to happen here. Like, where do you think that goes? Because the government's obviously not going to let this happen. They're not going to let other currencies pop up because they have, um, it affects so many things. Like, that's their power, right? Their power is the money, and that's why they own it. Every country does this. It's not just us. Every country wants that power. Um, so where do you think that goes? Because I mean, I think it's inevitable that we go to the CBDCs. Like, I don't think there's any way to stop it. The government can demand you pay. They can't demand you do transactions, but they can demand that you pay your taxes in the CBDC, which effectively means that it's essential to the system. So how does that kind of impact where things go? And is there anything we can do about it?
Yeah, there's a lot we can do about it. They could even demand that you use them. Years ago, I mean, thousands of years ago, money had what was called a demurrage, meaning that if you didn't spend X amount, you got a penalty. You got a minus 5%, right, in your account. And we saw this in Europe maybe 10 years ago now, where when interest rates went negative, people were actually getting a negative charge in their bank accounts. So yeah, there's a lot that can happen. This is why we've sort of been moving into this realm of surveillance capitalism. And this would be linked to a carbon credit or to a certain amount of, whatever your carbon quota was, you wouldn't be able to access your money beyond that. And, your social score is still being calculated in a whole host of ways. The concept of getting a personal digital ID that documents you on the internet everywhere you go. Merrill Lynch already a few years ago was starting to give clients an ESG score based on how they were investing. Banks have been going through people's credit card statements to see where they spend their money, all these kinds of things where we've been really losing viable privacy. And I think there's a lot we can do about it. The more that we acknowledge that this is happening and we push back and say, we're going to either move our business, we are not going to accept it. And it takes a small portion of the population to push back. So few people call representatives, so few people actually reach out, that when a reasonable amount of people do, it's in this world where we believe we have no power in the political system, I think we actually have more than we believe. I think it was T-Mobile last month that said they were going to go through people's text messages, and if they felt that people were texting some type of inflammatory statements, they were going to cancel their cell phone service. And so these are the kind of things that we have to become more aware of and say, absolutely not, or we're going to move our business, because we will go to a system where you almost won't be able to access your bank account without your phone. So on the dark side, the push absolutely is to control how much access you have to your money. A draconian version of a CBDC would be linked to how much you can spend. I think that, there's something called C40, or a movement for cities in the US. I think 10 of them had talked about signing up. And Phoenix still has said that they're interested in pursuing it, that by 2030, no private cars, no dairy, no meat. And you can buy 3 new articles of clothing a year. And you can, I think, fly one long haul flight every 3 years. I think the more that people hear these ideas, they won't accept them. And this dialogue will get bigger. I do think the system will back down a little bit, and we'll be able to talk about why a CBDC and how that CBDC will be shaped. Will something that really actually helps banks be more transparent and settle things quickly? Banks want it, they also don't want it. And what we will do, I think, is really begin these alternative currencies. And as they start to become, as all these little pods and prototypes of alternative regional and community currencies start, and we start to get this corporate money coming, there'll be a tremendous power to concentrate and keep in check anything that's coming as digitized central money.
Yeah, so I want to ask you one final question as we kind of wrap it up here, and only because it's probably the most common question we get, which is I mean, people talk about like cryptocurrency. Like, don't we already have digital money? Like, what's the difference between what we have now, which is just numbers on a screen on a page? It's just digital anyway. What's the difference between that and blockchain or cryptocurrency?
Well, there's a huge difference. So we do have digital money, and that would be the question where somebody would ask, why do we need a CBDC when effectively we truly only have digital money? The difference between blockchain is that system, if you take the Bitcoin blockchain, it's actually tested and verified every 10 minutes, right? And you take the current financial system, it is constantly under attack, and money, sadly, is being stolen all the time. And there's just insurance policies on that, where people don't really realize how much their money is still at risk in these financial institutions. But when they go to a good financial institution, they have the assurance and insurance that their money is safe. So the difference when we go to a blockchain system, and as this starts to get into our traditional systems, they're going to be safer. They'll be much, much more transparent. They'll be verified much more readily, and they will reduce costs, which hopefully and certainly in a competitive economy will come back to the investor in many different kinds of ways, whether it will be through lower borrowing costs, higher interest payments. In essence, we're going to be able to maintain more of the fruits of our labor. We're going to have more control over where our money is and where it goes. And as the traditional financial systems begin to really adopt and integrate these systems, there's going to be more safety and functionality in our current systems.
Great. Well, Kristen, I really appreciate you coming on the show and sharing your wisdom with us. Where can people find more about you?
Oh gosh, my website is my name, KristenRagusin.com, which is KristenRagusin. I'm on all social media under my same name. And I've written this beautiful book that's actually, my mom was my first reader. So it's written in the most simple terms. I wrote it for myself after 10 years of research to consolidate and bring back this ancient wisdom and this simple understanding of the money system that we need to bring back into the schools and everybody needs to get educated about. So my hope is that we bring up the competency, and this immediately will shift the power back to us and help really return our investment systems as well. So it's on Amazon, it's at every big retailer, Audible, you name it, Barnes and Nobles. But come follow me on social, and you certainly can sign up for the newsletters and everything else on the website.
Great. Well, Kristen, I really appreciate you coming on the show and sharing your wisdom with us.
Oh, thank you so much. So much fun. Thank you, Kirk. I really appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right, well, that was a great interview with Kristen. Appreciate her coming on the show. Now we're into the panel portion of the show where we have our very own Barb Freeberg. Hey, Barb.
Hi, Kirk. Hi, Megan. Happy to be here.
Glad to have you. And we also have our very own Megan Gorman. Hey, Megan.
Yeah. Hey, Barb, Kirk. It's good to see you guys.
Yeah, great to have you both on the show. So let's start with you, Barb. So what were some of your takeaways from the interview?
I can't get by the fact that Kristen said that she saw the 2008 market meltdown coming and she got all her clients out of the stock market. That's pretty amazing, given the research on timing the market is fraught with losses. So that was one of the takeaways. The rest of the takeaways were, we got a little bit to discuss here. I think overturning the monetary system might be a little bit much.
Hard to do that before lunch.
Yes. Agreed.
So, Megan, what about you? What are some of your takeaways?
Yeah, well, first of all, I mean, just to toggle onto something Barb just said, I think it is important to talk about market timing, right? We're at one of these weird inflection points in the market, right? Where people are cynical about what's going to happen. We've got 2 wars going on, a really challenging presidential election. I do feel that market timing is sort of contrary to everything that I do. And that was the thing in listening to the interview, which is I have a lot of respect for people who want to try out different things in the investment market. But I think it's very important to know who you are as an investor. And we've talked about this numerous times on the show. But, you know, as I was listening to the interview, I kept thinking to myself, I get why people may be intrigued by investing in crypto or want to do it. But for me, philosophically, and for my clients philosophically, it's not an arena I want to play in. And if I do, it would be in a very, very distinct setting.
Yeah, I think the concept is, I mean, it's really interesting because it's going, through the roof. But, when I hear topics like this, I guess I think of it as apocalypse porn. Like everyone thinks the world's going to end and they like talking about how the world's going to end. Oh, we got an election. Oh, the world's going to end. We're going to have a civil war. By the way, I have to say this. I said this on one of the live episodes recently. For those of you who think a civil war is coming, go back in your bunker. Okay, it's not happening. If you stop watching the news, stop watching social media, it's not going to happen. If you can name one person that you've actually met that wants a civil war, please let me know, because I've never met a single person who does this. Now, the media will pull out some crazy kook on the left or crazy kook on the right who's got, submachine guns and living in a bunker with MREs. I don't really count those people because they've been here for decades. Okay, this isn't anything new. But for anyone else, if you've ever met anyone who's ready for a civil war and wants one, please let me know, because it's not happening. So this apocalypse pornography is just, to me, it just aggravates me, because we as human beings get triggered by the end of the world because it's fear. And so any aspect of the world's going to end immediately triggers that fear center in your brain and says, all right, I got to prepare myself, which is good. It's normal, right? If you don't have that, then you should have your head checked. It's a very normal human response. But you need to be able to control that. You need to be able to look at things practically and say, well, maybe the world's not going to end. And if the world does end, what's really going to matter? If a meteor hits the earth and ends life, do you really need to prepare for that? And if you do you really want to live in a world where that is the outcome? So I think if you kind of look at the practical nature of this sort of thinking, it leads you to some inevitable conclusions. And one is, if things really get that ugly, can you really prepare for it? Right? If we do have a civil war, is the stock market going to really matter? Right? Is your retirement nest egg going to really matter? Well, probably not. So if you I always think about it as, you have to remove those scenarios, not because they're not possible, but because if they actually happen, any sort of planning is going to be a moot point for most people. So you kind of have to remove that from your thinking. And I know it's hard, because I think about it all the time. I think, well, what's going to happen if a really bad event happens? Whatever it is. I have a plan with my family, like, where are we going to go? Okay, we're going to go here. We're all going to, if there's no cell towers, we can't communicate. How are we going to meet up? Like, we have that just as a family, just so if something bad happens, we're mentally prepared for it. But am I hoarding my gold? Am I going to bring my leprechaun pail of gold coins with me as I run away? Probably not. Like, I don't have that kind of plan in place. So if you kind of remove that and you think to more normal scenarios, what are some more probabilistic scenarios that you can plan for? And I think part of this is where the cryptocurrency allure comes in, because it does solve some bad yet livable scenarios that people could encounter. But it also opens up some other questions. Like, if our current, like, people think, well, the dollar is going to go to zero. Over the last 100 years, it's dropped 97%. Okay. Maybe it has. Is that going to happen in the next 100 years? Well, 100 years is a long time. I would like to think I'm going to live 100 years, but let's say I don't, and that's a long time. So what is the outcome you're trying to accomplish? And I think most people don't think about it this way. So I also want to point out, I want to lead this to the panel here, is that cryptocurrency is relatively new, and there's a lot of things that are not known about it at the moment. So Barb, I know you're always an early adopter type. How do you handle new technologies? Are you the first one in the door, or how do you handle that?
Very funny. I am not an early adopter. I'm an early reader. I know what's going on. I know what the early adopters are doing.
Wait, Barb, say that again, because that's a big thing. I love what you just said.
I'm an early reader. I read a lot. I
Yes.
keep up with the trends. I know what's going on in finance, in technology, and investing. But in terms of being an early adopter, I'm going to wait. And the data is out there that the early adopters, some of them really hit it big. You know, first in the door with Apple, with Amazon, with Microsoft. Those who not only were first in the door and held on, okay, they're doing great. But does that mean that if you got in when the stock or the company was 10 years old, that you didn't make a profit? Absolutely not. There's plenty of room in the investment arena for those of us that want to see if a trend plays out. They want to see if, is this going to be a hit or a miss? I'm kind of like the investor that wants to stay with the proven strategies, the research-based approaches that have been time tested. Am I going to have the greatest gains in my portfolio? Absolutely not. But I am also not going to have the greatest losses.
So,
You know, can
go
I
ahead.
jump on to what
Yeah, go ahead, Megan.
Barb's saying? Because I think Barb and I come from a very similar way of approaching the markets. And I love that she talks about being an early reader, because I think reading constantly is important. I think in terms of being an early adopter, when I'm looking at clients in high net worth and ultra high net worth, they do have a certain luxury that most investors don't have, which is they're not just going after it in the public arena, but there's the private arena, right? And so when I think about my clients and being early adopters, like Barb, they tend to read a lot. I'm always amazed at how researched they think about certain things like crypto or AI or cannabis, right? These things that are out there. But how they get access, and this is the one area where I feel very comfortable gaining access to crypto or blockchain technologies, right, is in the venture capital space and in a very distinct sliver of a portfolio. So if you think about the life cycle of a company, you can go from venture to a full US mega cap. Like Barb, I want to be diversified amongst all of those assets. But when we are doing things like venture capital, it is not uncommon for some of the opportunity sets to be in blockchain technology. And it's being monitored, it's being due diligenced, and it is the type of early adoption that I feel comfortable with, provided the opportunity set is with a top tier provider or manager, like an Excel Partners or an Andreessen Horowitz, or those proven managers who know how to access early adoption. But for me to go out there and to start investing in crypto or investing my clients in crypto, I am not comfortable with that, because I feel that it's just not ready yet. And I would be putting too much risk in the investment portfolio by doing so.
So I want to ask you both, because you're both very similar in that way. What would be the catalyst for you to say, okay, now I'm ready to jump into this thing? Like, what is that point where you're like, all right, now I feel comfortable? Because, I know for myself, like when I was younger, I was a tech hobbyist. I just enjoyed, learning about tech, getting involved in tech, and just, am I the early adopter? Not necessarily, but I was more early adopter when I was younger than I am now, because it just, it's like a whole nother profession to stay up with this stuff. So at what point, Barb, do you say, all right, I'm comfortable enough? You've missed the early run, but you've also missed the early risk. Like, how would you define that?
That may be one of the best questions you've ever asked me, Kirk.
Thanks.
And my answer is I have made so many mistakes on the entry and exits that I don't think my opinion is worth anything, because I owned Oracle, Microsoft, some really top tier tech companies back 25, 30 years ago. And after making, nice profits, I sold out and never bought back in. Now I own those companies through the ETFs that I own. So, I'm in those, and I don't do a lot of individual stock investing anymore. Additionally, I believe it was around 1990 or so, when the Berkshire Hathaway B came out, I was like, well, I'm not going to invest in this because I miss Berkshire Hathaway A, and so I'm not, it's too expensive now, so I'm just going to skip it. Huge mistake. Okay, had I invested in 1990 in Berkshire Hathaway B, I would have done very well. Another example of my screw-ups were with Bitcoin. I didn't want to go into Bitcoin, but I thought to myself maybe 4 years ago or so, I thought, I'll invest in Coinbase because they are the ones that are impacted by not just one cryptocurrency, but the trading of many cryptocurrencies. So I invested in Coinbase. It had a nice run up and then a huge drop. And I'm like, okay, well, I'm going to sell it. Sold it. And since then, it's had a great run up. So the answer to the question is, don't ask me that question. I am not good at picking entries and exits. But let me say one more thing in my defense. What has worked the best for me is the empirically supported regular investing. That means every month, every quarter, every half a year, whatever, in a diversified array of U.S., international stock funds. I play around with a little bit of our portfolio in individual stocks, and some of them do well and some of them don't. I'm net up in those, of course, better actually than some of my exchange traded funds. But picking and choosing, deciding when to get in and when to get out, I'm not really good at.
Okay, that's fair. I think most people, it's great that you acknowledge that, because I think most people are not, and frankly, it's hard and there's some guesswork involved. Megan, what about you? How do you decide? What's the catalyst you decide to say, all right, I'm not an early adopter, but it's at the point where I feel comfortable jumping in?
Yeah, so I think that, what I would tell you is where we typically make that decision is, every vintage that we do in the private markets, right? So as we're doing different vintages and we're working with the same managers who have proven track records, as they start to layer things in, like blockchain technology, like AI, that's where we start to have a comfort level with it. But again, it is not going to be a heavy part of the portfolio because, like Barb said, we're looking for a diversified portfolio, a certain projected rate of return, and to be sort of boring and steady Eddie. So when I have clients who really want to embrace something, right? One, there can sometimes be specialized private funds in that area that might warrant investment consideration, or we simply encourage them to get a sidecar account where they're managing and playing in the crypto markets and so on, and seeing if they can have fun with what they're trying to do. So, I still always come back to the tenet that the best investing is often the most boring. It really shouldn't be something that you should be excited about talking about, because like Barb said, chasing return and trying to find the right entry points and exit points is incredibly difficult. So treating it more as a science and following the science is often the best way to have a satisfying experience with the portfolio. And I know you're probably like, satisfying? Who wants a satisfying experience with the markets? But who wants to be up, down, and all over the place all the time? It's just too hard to master that.
I
Yeah.
have to jump in.
Okay.
Sorry, Kirk.
Go
I have
ahead.
to jump in.
What did I say that was wrong?
Well, I've got nothing you said is wrong, but I need to address two things.
Mhm.
First of all, market matching returns are nothing to sneeze at. Since 1928, the aggregate S&P 500, which are the 500 largest US companies, has earned an average of 9-10% a year. Now, that doesn't mean that's going to happen going forward, but let's say you earn 7 or 6% a year. That's nothing to sneeze at. 7% a year, your money doubles in 10 years. Bonds on average during the last 100 years have earned 5%. So that's tough to beat. For long-term investors, it has been proven time and time again with empirical research that active investors, those that are jumping in and out of the markets, and this is Vanguard research. This is, not some Joe Schmo on the corner doing these calculations. Active investors typically underperform the overall US stock market and bond markets. So that's one point. So there's a lot to be said for just a plain vanilla diversified index fund portfolio.
Barb, can I ask you
And
a quick
then-
question on that?
Yes,
Last
of
year, do you
course.
think active management or passive did better?
What did you, well, I didn't hear the first part of your question.
Did you, because you're saying, index based, right? I'm just
Yeah.
curious, last year, would you have said active management or index did better?
I don't know what last year was, and I don't care because I'm not investing on a year by year basis.
No, I hear you.
Yeah, so I have no idea, but over time, I will say in aggregate, passive investing has outperformed active investing roughly 70% of the time.
And the only thing I'll say about that, and I don't have the stats, so I'd have to look it up. I think it also comes down to who you are in the market. I do find at times when you're institutional, ultra high net worth, because you get access to certain types of active managers, I do think sometimes active management wins more than 30% of the time. I mean, I know that but again, but I would put a caveat on that because it's the opportunity sets that you can get access to. And so I think for most investors, indexing probably makes the most sense unless you can get access to the institutional sides of the market.
And that was actually bringing me to the second issue I had that I want to talk to you, Megan, about, because first of all, I love you, but most of us don't have $20 million net worth.
Right.
And that's, I would guess, probably the floor of your client base. And so it's interesting to hear about what you do, getting into the private offers, but and I think we can learn from their strategies, but it's not going to be applicable for most of us.
Correct. By the way, I agree completely. I think that one of the things that I've found over the years in working in that segment of the market is we're in this time period where everybody wants to be wealthy, but then they want to disdain the wealthy, right? And I think as a result, when you are in the higher end of the market, people don't talk about what those people really do, right? That there's, and I think it's important to at least explain that a lot of times, a lot of their portfolios look like everybody else's portfolio, right? They own the S&P 500, right? You get small cap, you get international developed, you get emerging markets. I think what it's important to do is say that there's a difference in sort of some of the access to some of the investments out there, but even having access doesn't mean you get the best opportunity sets. And I would tell you that when you're working in that end of the market, there's a lot of crap out there, just as much as there's a lot of good access to the right types of managers. It is a complex minefield. And I think it comes down to, regardless of who you are as an investor in the market, due diligence is so key. So going back to what you said earlier, Barb, and why I think it's probably the best thing said on this right today, is you're an early reader, right? And I think that regardless of how much money you're putting into the markets, you really need to be educating yourself at all times, even if you're making the choice that it's not time to deploy. And that's, I think, the biggest key about being successful in the markets and feeling satisfied with investment results. But I agree with everything you said. It's a very weird segment of the market I deal with.
Yeah, it's interesting. I think, you know, as investors, we all get allured by the high returns. As you said, Megan, you know, when you get into the institutional side, and you get to the ultra high net worth side, there's access that normal investors don't get. And if you look at the endowment portfolios, you look at the large institutions, they're not indexing. Like, very clearly, they're not indexing. They've moved far away from that in the last few decades. So you have to ask yourself, and I always love these typical rules of thumb that people give investors. Oh, you should just index. Maybe. I think if you know nothing about the markets, you don't know what you're doing, yeah, that's probably a better strategy. But if you really want to pursue better returns, there is a lot of stuff out there. Like, if you look at some of the top colleges, you look at like Harvard or Yale and some of their endowments, there's like 5 to 10% in the publicly traded markets. There's very, very little. Most of it is in private investments, stuff that you and I won't have access to, right? Just, you know, things that you have to have a minimum of 100 million, you have to have 20 million in the investment, some crazy numbers that most people don't have. So it's not practical to get access to some of these top hedge funds and private equity and venture capital. But it does exist. And the returns potentially are a lot higher than the S&P, which is why these big institutions invest there.
But can I just jump in here though?
Yeah,
Because I
go ahead.
run a $200 million endowment. We do have, I mean, you do index in these things, right? There is our index funds being used because as an endowment, you're dealing with all this fee compression. But what endowments and pensions funds do, which most people can't do, is like, I have a mandate that we must meet quarterly. And we work with Cambridge, who's one of the top tier advisors for endowments and pensions. What they're doing that may be different for most investors is there is rigid diligence and there's rigidness on following asset allocation. And so that's how they're able to make some of these decisions to use active management in both the public and private space. But I don't want people to think they don't use indexing. I mean, we use indexing all the time. But they're really good at following the mandate, and they are very, very engaged in the portfolio on a deep level that the typical investor cannot do for a variety of reasons. Partly it's because that's the sole reason for the endowment and the manager managing it. So it's hard to make it apples to apples with what normal investors do, because they're just approaching it very, very differently and with a very different mandate and time horizon.
Well, I think what you just said, I want to pick up on the last thing you said there, which is time horizon. And one of the biggest differences between endowments and individuals is endowments have a perpetuity, typically, time frame, that their time frame is forever, whereas mine is as long as I'm alive and whatever my time frame is. But there's a limit to my time frame, right? I retire in X amount of years. That's my time frame. Whereas an institution, I don't need it for another 500 years to just invest it. And I think that plays into this because there's a lack of liquidity with a lot of these private investments. Whereas the public markets, I can buy or sell in a hair of a second if I wanted to. Whereas if I invest in some real estate deal, I got to wait until the deal's done. And that can impact a lot of people. I was actually just in a dinner last night with a guy who was talking about GP stakes and investing in sports franchises, and it was really interesting. But it's not for Joe and Susie Lunchbox. Like, it is, you're investing in this, and you're in there for 7 to 10 years. You might be, if you're so inclined, you might be in there for like, you know, the rest of your life, right? It just depends on the time frame is a big part of that. So I appreciate you mentioning that, Megan.
Yeah, yeah. And it's a part of what you're talking about is the illiquidity premium too. So, you know, most of these private investments are 10 years with an additional 2 + 2 years to be tacked on. And so again, they have to be illiquid for a long period of time. And they're hoping by giving up liquidity, they get rewarded with additional premium. The hard part in these types of portfolios is they are often, when you're doing private equity, venture capital, is you're subject to what's called the standard J curve, where you commit money, you put it to work, and then the first 3 to 5 years, it drops in value until you can harvest. What's been interesting in the endowment, pension, private market worlds recently is because of market movements, particularly from 2021 and 2022, a lot of these funds became over allocated to private markets and they had to move out of their positions. So what has been the trend over the past year is what we call secondaries, where if I'm an endowment, but I'm over allocated to the private markets and I have to get out, I can offer my spot to somebody else and I'm further through the J curve. And so they get distributions quicker. So they can make these sort of crazy decisions. I mean, they sound crazy, but it's very logical because they stick to their asset allocation knitting. And if the asset allocation says we're over deployed in this area, they must act.
Yeah, no, that's great insight, Megan. So as we get close to wrapping it up here, I did want to touch on a little bit of the, I mean, this is mostly about cryptocurrencies, but I'm curious whether you both invest or not. I know I do, and I'm not an early adopter, but I also have a different viewpoint on things like this, and I'll just share mine and love to get each one of your opinions. Is that, when you're investing in something like cryptocurrency, which is early, it's maybe not as early adopter anymore. It certainly has been up until now. The question is whether the release of the ETF makes it no longer early adopter. I think it technically still falls in that bucket because there's there's a lot of potential use cases. The use cases are still limited, so I would still deem it as early adopter status. However, it's easier to access, which changes the dynamic. However, I look at something like cryptocurrency as speculation, and most people look at it as an inflation hedge or whatever they want to call it. It's a speculation. I think it's very clear. But I also look at it and say, all right, let's look at the math. Forget what it's all about, right? Forget whether it's going to apply or not, whether it's going to be the savior, the end of the world is going to zero. It doesn't matter, okay? But let's look at it from a practical perspective, okay? I look at cryptocurrency and say, here is probably the most volatile asset on the planet, and it also has some potentially really large upside for people who believe that, right? But it could also go to zero, right? You're not going to lose unless you use leverage. As if there's no leverage, you won't lose more than zero, but you could lose all the money you put into it. So if I put in $100, I could lose $100, and I have to acknowledge that going in. So I'm not going to put $1 million in if that's all my money, and because it could go to zero, and then I'm back at square one. However, it could also go up 20x from where it is now. I'm just throwing out numbers. Let's say it's 20x. Okay, let's say it could go to $1 million per coin. Okay, well, that's a large number. It could go to zero, or it could go up 20x. Now, if I'm in a casino, right? Let's say I'm playing a casino game, and the outcome is I could put in $100, I could lose my $100, or I could make $2,000. And let's say my odds of winning are 50-50. I'll beg, borrow, and steal to go play that game every day of the week because those are good odds. Now, if you understand statistics and math, you realize what I'm talking about is you're flipping a coin. If you get heads, you win $20. If you get tails, you lose $1. That's a great game, right? 50-50 odds. Now, I'm not saying that cryptocurrency is 50-50 odds. I'm using it as an example. I deem the odds to be somewhere around there. Maybe it's 40 or 60, but it's somewhere in the middle. It's not 1 and it's not 100, right? It's probably somewhere in the middle. So if you're looking at that and saying, all right, I'm looking for an asset that keeps up with inflation, which I think we all know is higher than what it's, what is disclosed by the government. It's, if you've ever bought food, it's higher. But I kind of look at it and say there's very few things that are going to be a hedge against inflation in this environment. And I wouldn't call this an inflation hedge, but it's something that has the potential to do a lot better than inflation, where other than technology-based investments, it's hard to find that. You're not getting that through bonds. You're not getting that through general value stocks at the moment. You're not getting it through gold, although gold bugs will tell you different, but you're not getting the same inflation hedge. We haven't seen it. You're not getting it through silver, other metals. Like there's very little out there that's actually keeping up with inflation. Real estate typically does, but we talk about the real estate market in the show, there's a lot of let's just say speed bumps in the way for that to keep up with inflation the normal way. So I guess I look at things in that way, and so I'm curious how each one of you see this, and then maybe we can kind of wrap it up here as we come up on time. So Barb, what are your thoughts?
Kirk, I like what you said. I think it's very reasonable. I want to start off with a quick statement about asset allocation, then answer your question. So again, the research has shown that your ultimate investment returns are more dependent on your asset allocation, which means just the general mix of stocks, bonds, alternatives, and speculative investments, cash. So your returns are more dependent on your asset allocation than they are the specific assets you choose. So that said, conservative older investors typically invest with more fixed assets, cash and bonds, and fewer stocks and speculative assets. Younger investors who have time to make up losses definitely go all in more on the speculative, on the stocks, on the other types of riskier assets with the possibility of generating higher returns. Okay, so that's just asset allocation in a nutshell. On to cryptocurrency. I agree with you, Kirk. It is a speculative asset. We just don't know for sure what the future holds for digital currency. I think blockchain is definitely a sure thing. There's no doubt. There are tons of uses for blockchain, and those of you who are interested can buy a blockchain ETF. And you just get a diversified portfolio of blockchain companies, and you're done with it. Crypto, yeah, it's speculative. I love having a portion of my portfolio, 4%, 5% in speculative assets. That gives me the freedom without worry of jamming up my other asset allocation, which I'm very confident in fits my risk tolerance and my longevity, because I'm going to die in a couple of decades, maybe 3 if I'm super lucky. Okay. So I'm not in crypto now, but I'm not against it. I think, invest in crypto and see what happens, but don't put all your money there.
That's good advice, Barb. Where can people find more about you?
You can find me at Barbara Friedberg Personal Finance. You can also find me on my YouTube channel, Barbara Friedberg.
Great. Thanks for coming on, Barb. And Megan, what about you? What are your ultimate thoughts about crypto, its place in a portfolio, and final thoughts on the matter?
Yeah, I think intellectually it's a really interesting concept, right? And I think, like Barb said, you are going to continue to see it evolve, right? Investing in blockchain is going to be the wave of the future. You think about healthcare companies, you think about the government, right? Blockchain can't be forged or data manipulated. So it's a really interesting area. But to what Barb said, you don't put all your eggs in one basket, right? You have to think about things diversified, because there's a lot of stuff out there that you should also be invested in that might not be as sexy as crypto or blockchain. So again, think about what's in your portfolio, what you have comfort with. And, we've talked about before, but there are great tools out there at Morningstar where you could do a deeper dive to see the underlying holdings that you're in. And then just to sort of toggle onto what we touched on before, when I do talk about what my clients are doing, this doesn't mean it's appropriate for everybody, right? For most people, getting access to the right private markets and investments isn't really possible. So I just caution everyone to be wary there. So I'm Megan Gorman, and you can find me at megangormanauthor.com. Kirk, thanks for having me on.
Yeah, thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com, and of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.